There's a moment every investor knows well. It's quiet. Nothing dramatic is happening, but inside your head, one question keeps repeating itself. Should I sell now and lock in my gains? Should I hold and see how far this can go? Or should I buy more while everyone else is getting nervous? That question has cost people more money than recessions, wars, or crashes ever have, because the danger isn't the market. The danger is how humans react to it. I've been making financial decisions for more than 70 years. I've seen cycles repeat so often that the details change, but the behavior never does. Every generation thinks this time is different, and every generation learns the same lessons the hard way. When prices rise fast, confidence turns into greed. When prices fall fast, fear turns into panic, and both lead to mistakes. When everyone is talking, you should be listening carefully. Let me tell you something simple and uncomfortable. When an asset becomes the main topic at dinner tables, when your barber starts giving you investment advice, when the price chart looks like a straight line upward, that's not usually the beginning of opportunity. That's usually the beginning of danger. I lived through the silver frenzy of 1980. I watched people mortgage their homes to buy metal because they were convinced prices could only go higher. For a brief moment, they felt like geniuses, and then the market reminded them how fragile confidence really is. I saw the same story repeat with gold years later. Same excitement, same certainty, same regret. The market doesn't change. Human psychology doesn't change, only the asset does. Why I once bought silver and why that matters today. Years ago, I did something unusual. I bought silver, not because it was popular, not because it was exciting, and certainly not because I thought it would make headlines. I bought it because the numbers didn't make sense. Industrial users were consuming more silver than the world was producing. Inventories were shrinking year after year, and yet the price hadn't moved in a long time. That told me something important. The asset wasn't expensive, it was mispriced. So I bought it, I held it patiently, and when the imbalance corrected and prices reflected reality again, I sold. No drama, no predictions, no regret. That experience taught me something critical. You don't make money by predicting where prices might go. You make money by understanding why you own something. The difference between investing and gambling. Most people confuse investing with guessing. They buy because prices are rising. They sell because prices are falling. They call it strategy, but it's emotion. Real investing starts with a question most people avoid. What do I actually own and why? If you can't answer that calmly, you don't own an investment. You own a source of stress. Silver, like any commodity, does not produce income. It does not grow. It does not innovate. It simply exists. Its value comes entirely from what someone else is willing to pay you later. That doesn't make it useless. It means it must be handled carefully. Price is not the same as value. When an asset moves quickly, emotions exaggerate everything. Optimism becomes certainty, doubt becomes denial. That's when rational thinking matters most and when it's hardest to maintain. The first question you must answer before you decide to buy, sell, or hold anything, Ask yourself, why did I buy this in the first place? Not the excuse you tell yourself now, the real reason at the time. If the reason still exists, price alone shouldn't force you to act. If the reason was excitement, fear, or someone else's opinion, then price movement is already telling you it's time to rethink. Most people don't lose money because markets move. They lose money because they never defined their reasons.
Once emotions are set aside, investing becomes simpler, though not easier. The next step is always the same. Ignore opinions. Ignore predictions. Focus on facts. Silver didn't rise randomly. Demand has been exceeding supply. Industrial usage has expanded dramatically, especially in energy, technology, and medicine. Production hasn't kept pace, and new supply can't be created overnight. Those facts matter, but facts alone never tell the whole story. Why fundamentals matter, but don't protect you from volatility. Strong fundamentals can justify higher prices over time. They do not protect you from sharp drops along the way. Markets don't move in straight lines. They overshoot in both directions. Optimism pushes prices too high. Fear pushes them too low. Investors who survive understand this. They don't expect smooth progress. They expect turbulence, and they prepare for it in advance. Speculation hides inside good stories. Here's where people get into trouble. They hear a good story, rising demand, limited supply, global trends, and they assume price movement must continue. That assumption is dangerous. When speculation enters the picture, prices can detach from reality for long periods. That creates opportunity for disciplined investors and traps for emotional ones. The presence of strong fundamentals does not eliminate risk. It simply explains why prices moved. Understanding margin of safety. Every investment decision should be filtered through one concept: margin of safety. This means buying at a price low enough that even if things don't go perfectly, the downside is limited. When prices are low and sentiment is negative, margin of safety is high. When prices are high and everyone is excited, margin of safety shrinks. That doesn't mean prices must fall. It means mistakes become more expensive. 3 types of silver owners. At this point, investors usually fall into one of 3 groups. First, those who bought early and are sitting on large gains. Second, those who bought late and feel uncertain. Third, those watching from the sidelines, afraid of missing out. Each group requires a different mindset. The mistake is treating them all the same. Why partial decisions are often the smartest ones. Most people think investing decisions must be absolute, all in or all out. That thinking creates unnecessary pressure. Selling part of a position reduces risk, locks in progress, and preserves upside. It's not weakness, it's discipline. This approach rarely feels exciting, and that's exactly why it works. Late buyers and the danger of attachment. Buying late doesn't make you wrong, but it does reduce flexibility. Late buyers must be especially careful not to fall in love with the asset. Momentum can reverse quickly, and emotional attachment delays action when it matters most. Discipline is hardest when profits are small and uncertainty is large. That's when it's most valuable. Sideline fear is still fear. Those who don't own silver but feel anxious watching prices rise are experiencing fear too, just in a different form. Fear of missing out. That fear pushes people to buy at the worst possible time. It disguises itself as logic, but it's emotion. Patience is not inactivity, it's a deliberate choice.
Discipline, decision-making, and the only rule that never changes. After all these years, I've learned that markets are just mirrors. They reflect who you are under pressure. They reward patience. They punish impatience. They expose emotional weakness. Silver is not special in this regard. It simply happens to be today's test. Why bull markets create false confidence. One of the most dangerous moments in investing is after a winning streak. Success feels like intelligence, luck feels like skill, and slowly risk increases without permission. That's when portfolios become fragile. True discipline means acting the same way after success as you would after failure. That's rare and valuable. The biggest mistake investors make after winning. They stop asking questions. They assume momentum will continue. They delay decisions. They let greed replace planning. Winning doesn't require intelligence. Keeping the win does. A simple action plan that actually works. Here's what every investor should do, without exception. Write down what you paid, what it's worth today, and why you bought it. If the reason no longer holds, the position doesn't deserve your money. Clarity removes fear. Why boring decisions build extraordinary wealth. The most successful investors I've known weren't exciting. They were boring. They avoided unnecessary risk. They avoided emotional decisions. They waited longer than others thought reasonable. And over decades, compounding did the rest. The final truth. Markets will tempt you every day, with excitement, with urgency, with fear. Ignore it. Focus on process, not prediction. Wealth is not built by dramatic moves. It's built by disciplined ones. Silver may rise, it may fall, but your behavior will decide whether it helps you or harms you. Closing wisdom. Every decision you make today is shaping your future. There is no neutral. You are either acting with discipline or reacting with emotion. Choose carefully, because in the end, the most valuable asset you will ever own is not silver, stocks, or money itself. It's the ability to think clearly when others cannot.